name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. I'll start with ICE Raw New York Sugar. I'm once again still sorry for the multitude of lines and labels that I've drawn on this daily chart. However, there is a lot going on here, technically, and they are all valid in deciphering what is going on here. The declines early this year below the long moving average are as a result of three patterns created between August 2021 and January 2022. These patterns are, well, to start with, they are complex versions of normal workaday patterns. They are, and I'm going to do something normally I try not to, but I will highlight them with my cursor. So, pattern number one, a complex head and shoulders top from August to November 2021, which is going through here. There's the neckline, there's the shoulder, split, head, shoulder. The neckline's running up along here, and it's currently at 2102. Pattern 2 is a complex triple top from August to November 2021. And this one you'll have currently here again 1, 2, and 3. So it's not this, it's using a similar situation but looking at it as a triple top. The neckline for that is much shallower, and that runs through at 1976. And the third pattern, the most recent, is an awkward head and shoulders pattern from October 2021 to January 2022. So this is the shoulder, which is the head in the previous pattern, the head, which is the shoulder in the previous pattern, then the third shoulder, and the neckline is here. That has a neckline running currently at 1765. Now, patterns 1 and 2, they can be somewhat disregarded as the targets below for both have already been reached. And it is only the general bearish activity created by these two that we need to consider. Pattern 3, the awkward head and shoulders pattern, is still ongoing and needs to be carefully considered. You see, over the last 9 weeks or so, prices have tried repeatedly to break below both this neckline and the long moving average, currently at 1878 for that. Now, the market has managed to close strongly below the long moving average, and even on occasion close below the neckline, as well as the 50% Fibonacci line, or the 21st century absolute Fibonacci line at 1809. However, these closes have been more like breaches below rather than pure breaks below. The glaring example of this was 3 weeks ago when the market created a weekly key reversal down and looked all set to crash down through the neckline. Yet the following week, so that is 2 weeks ago, despite the Monday and the Tuesday making fresh lows, not seen since early January, the market about faced and rose up, making an immediate countering weekly key reversal up that punched up through and closed over the medium moving average, currently at 1896. Indeed, the only thing that managed to cap the rise was the neckline, currently at 1976, of the previously mentioned complex triple top from August to November 2021. And that is where we are at this time, supported below by the medium and long moving averages, the February 2021 high at 1894, the 50% Fibonacci line for the 21st century at 1809, and the 50% Fibonacci of the March to November 2021 move at 1768. And ultimately, by the neckline, currently at 1765, what can now be seen as a continuation head and shoulders pattern. Meanwhile, on top, we have the triple top neckline, currently at 1976. ICE Europe white sugar in London. The market made a big deal out of the breakout of the September 2021 to February 2022 lopsided diamond pattern. A number of false breaks in both directions, including a gapping changeover until 3 weeks ago the market made a gapping move higher through all the moving averages, and finally 2 weeks ago punched up over the 2021 high of 530.60 and filled in a gap between 531.70 to 532.70 left over from March 2017. However, doing that seems to have been enough on the upside for now at least, as the action from 2 Fridays ago plus Monday last week combined to make a 2-day bearish meeting lines pattern. This was offset last Tuesday by an immediate countering bullish thrusting pattern. But the bearishness returned on Wednesday with a counter to the counter bearish engulfing pattern. And last Thursday's inverted hammer pattern, well, now inverted hammer patterns are traditionally seen as bullish. However, data indicates them to be bearish continuation patterns about 6 to 7 times out of 10. Thus, it was no surprise to see last Friday heading lower, but then the market stopped, not even making it down to the support in the 517.80 area before turning back up. The move up 2 weeks ago reached both the primary and secondary targets for the diamond pattern. Once they were done, bar a bit of excessive behavior, it looked like the market may be coming down to the medium moving average, currently 504.10. However, you may notice that there is an old gap from March 2017 between 531.70 to 532.70 that was filled in last week. And it's perhaps this plus the highs, well, probably more importantly, the highs from November at 530.60 and 527.40, plus also October at 527.30 and 522.5, that have halted the decline and placed some indecision in on this market. It'd be interesting to see if we now have a top from up here, or a bullish half hesitation type pattern, or something else instead. Sugar white premium spread. We're back up to 3/4 key patterns running in this market. The first is one I've mentioned many times before, the mid-August 2021 to date uptrend, currently at 102.25. This is still quite a steep angled uptrend and one I would normally regard as having a limited lifespan. However, it's been in operation all this time, and during its lifetime has become a 5+ pointer uptrend. Thus, this is one to watch closely. The second one is another one that I've previously mentioned. It is the quiet and subtle bullish bow tie formation formed over Christmas. It consists of the rising short moving average, currently at 106.5, the rising short medium moving average, currently 97 even, and the flatlining long moving average, currently 76.5. What has been interesting was how all the moving averages went in and out of the bow tie formation in the right order, a rare feat in some markets. Now, theoretically, the market should move in the direction of the outgoing moving averages, in this case higher, which the market has already done so. However, the key move again, theoretically, should happen between 15 to 20 trading sessions after the crossover. In this case, it would be between the weeks of the 4th of April to the 9th of May this year. Hence, I would suggest putting a note in your respective diaries and calendars for that period, just in case. The next utilizes the existing uptrend which connects the tops since July 2017, such that we have a huge ascending triangle pattern, currently 102.50 to 111.75. In the next few weeks, this pattern will be squished into nothing. So it may well be that we'll have a break higher or lower soon. And beware of false breaks first off. Now, I cannot give an idea of which direction as yet, but I can give an idea of the size of the move. For a break higher, it would be about $50.50 on top of the upper trend line when it's broken, whilst a break lower would be about $25.75 off from the lower trend line when it was broken. If this is a true and accurate break, and it happened, say, for example, today, then it would be having potential areas topside in the 162.25 area and 76.75 below. Remember, these are big patterns over a long period of time. Finally, there's a pattern which, whilst not directly touched, may be indicative of the bullish angle of attack. It is the 2019 to 2021 bullish Andrews pitchfork. The market is currently in between the middle time overhead, currently at 128.25, and the lower time below, currently 54 even. Once again, no tine has been touched, but the upper trend line of the ascending triangle runs approximately parallel to the middle tine, and that is also something to watch. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.